Hello, I'm Brent Joyce, Chief Investment Strategist at BMO Private Investment Council. It's Tuesday, April 1st. Welcome to our first quarter of 2025 Global Markets Commentary. Worried headlines were the order of the day during the first quarter. Words and deeds of the new U.S. administration produced many heavy hearts and unpleasant surprises. But let's not forget one joyous 3-2 overtime Four Nations hockey celebration. Tariff pronouncements and threats are bound to continue for some time. On top of this, and because of this, there are growing fears the new U.S. administration's trade, immigration, and fiscal spending policies might lead to a U.S. economic slowdown that could spread to the rest of the world. Despite all this, capital markets in Q1 didn't reflect as much doom and gloom as the general mood on the street. A Canadian investor's representative, well-balanced, diversified portfolio is slightly up for the year. We implore clients to acknowledge this reality, double down on their efforts to separate understandably heady emotions from investment decisions, and stick to a clinical approach. The realities of what's best for the long-term health of our investment portfolios can feel cold and unpatriotic. That is the nature of capital markets. We must focus on reality and strike emotion from our portfolios. The self-inflicted damage to confidence in the U.S. weighed on their equity markets, as Q1 saw a rotation to international stocks at the expense of the U.S., illustrating yet again that diversification works. Diversification across equity markets and various asset classes is proving its mettle. We believe in both and practice both, an approach that is carrying us through this period of uncertainty. Absent the policy noise, the global economy and capital markets are poised for positive outcomes. The world is in the throes of a capital spending boom on artificial intelligence and other technologies, coupled with the build-out of data centers and infrastructure to support this insatiable appetite for more technology. These are leading to, and expected to increasingly lead to, productivity gains, which is more fuel for strong capital markets. Elsewhere, especially in Canada, the powerful stimulus of lower interest rates was beginning to feed through and boost the economy. China's ramping up of economic stimulus is another positive. All of this fits with the strong stock markets of recent years. Better growth and lower yields set a very positive backdrop. Clarity over U.S. trade policy can usher in the return of these animal spirits. Indeed, they're making valiant attempts to endure despite the uncertainty. Thus far, we don't see the recent capital market reaction as unusual or terribly alarming. Potential economic shocks don't automatically mean extreme shocks to capital markets. Remember, economic slowdowns are not unusual. They occur every few years. Economic growth slowed in 2012, 2015, and 2018-2019. None of those slowdowns triggered a 25% drawdown for U.S. or Canadian stocks. Growth scares can cause 10% to 15% drawdowns for stocks. The S&P 500, a market that was priced for perfection, has already witnessed a 10% correction, and encouragingly has bounced off that technically significant level twice. We've seen this many times in the past, and some parts of the U.S. market, particularly those that experienced the largest Trump bump at the end of 2024, were due for a cleansing. Capital markets are signaling their displeasure at the current U.S. policy trajectory. We think it is only a matter of time before the economic realities set in and the American political system and public rail at the negative consequences. We caution against trading based on headlines. We assess and act, never overreact. In our experience, the wisest course is navigating through, not around volatility. That's how we saw the first quarter of 2025. Thank you for joining us. We look forward to you tuning in next month.